In this video, we will continue to discuss issues associated with international trade. First, we will talk about the major trade agreements and the role which they play in shaping the international economic landscape. Next, we will present international organizations such as the World Bank and the International Monetary Fund, which provide financing to troubled economies. And finally, we will discuss the world's most important central banks and explain how they impact the global trade environment. As we already indicated in the previous video, trade agreements and common markets are international treaties entered into by countries interested in fostering international trade in a given type of good or service. Let us now take a closer look at the specific categories of such treaties which may be encountered around the world. The simplest type of such treaty is a bilateral trade agreement, in which two countries agree to eliminate quotas and tariffs in relation to all or selected goods. Examples of such agreements are the China-Australia Free Trade Agreement, also called CHAFTA, signed in 2015, or the Closer Economic Relations Agreement between Australia and New Zealand, referred to as CER. Multilateral trade agreements are similar, but entered into by a group of more than two countries. An example of a multilateral free trade is the North American Free Trade Agreement, or NAFTA, between the United States, Canada, and Mexico. When a multilateral free trade agreement is entered into by a bloc of countries located in the same geographical area, then it is typically referred to as a free trade area. An example of such area is the Commonwealth of Independent States Free Trade Area, signed by Russia, Ukraine, Belarus, Uzbekistan, Moldova, Armenia, Kyrgyzstan and Kazakhstan. As we indicated in the previous video, trade agreements on the one hand enable free trade among their signatories and on the other typically impose high barriers to trade with third countries. Accordingly, trade agreements also act as protectionist measures against excessive imports from countries which didn't sign the agreement. There is in fact a specific category of international agreement aimed specifically at protecting the signatories' markets from international competition, referred to as a customs union. Members of such a union agree to trade freely within the union, but simultaneously set up a common external trade policy including tariffs and sometimes also quotas. Consequently, a customs union represents a higher degree of economic integration between countries than in the case of free trade agreements, where each of the countries typically adopts its own external trade policy. An example of a customs union is the Andean Community, comprising a number of South American countries: Bolivia, Colombia, Ecuador and Peru. Single markets, also called economic communities, represent yet a further step in the economic integration of countries. Members of a single market remove all barriers to trade with each other in goods and services, including the freedom of movement of production factors, that is, of capital and labor. Simultaneously, the community also adopts a common external trade policy. The Mercosur, including Argentina, Brazil, Paraguay and Uruguay, is an example of a single market. The most advanced stage of market integration known to date is the Economic and Monetary Union, whose member states, in addition to a shared economic policy regarding internal and external trade, also adopt a common currency. The so-called Eurozone, that is a monetary union of 18 out of the 28 countries of the European Union, is an example of an economic union, with the euro being the common currency adopted. The liberalization of free trade globally is promoted and supported by the World Trade Organization, commonly referred to as the WTO, which is an international forum where 164 member states can negotiate rules pertaining to international trade and sort out disputes regarding trade barriers. The current focus of the WTO is the finalization of negotiations in the Doha Development Round, which started in 2001, with the purpose of establishing common rules of trade between industrialized countries and emerging economies. Since the launch of negotiations, several meetings have already been held. However, no binding resolutions have been achieved yet. This is primarily due to the lack of consensus regarding protectionist measures adopted by free trade areas against other countries, particularly with regard to trading in agricultural products. As you can see, despite the constant growth in importance of international trade to the global economy, protectionism still remains a significant issue, particularly in relation to less developed countries. Let us now consider the pros and cons of the protectionist approach to international trade. On one hand, it seems obvious that developing economies wish to protect their local industries from foreign competition. In such case, adopting a protectionist stance may offer these countries time to modernize their economies in order to make them more competitive. There is a threat, however, that trade barriers will be used to protect obsolete technologies which are not expected to ever become globally competitive. From this perspective, it may be noted that foreign competition may also act as a positive incentive to the economies of developing countries, increasing the pace of their modernization. Concluding, there is no simple answer to the question of whether protecting domestic markets is right or wrong. It seems that depending on the specific circumstances and decisions of local policymakers, the protectionist approach may either help a country develop faster when applied responsibly, or, as in the case of countries led by populists, to obstruct the increase of an economy's level of competitiveness, thus hindering the economic growth of the country. Continuing with the theme of underdevelopment, we will devote the next part of the video to the intergovernmental organizations which are aimed at supporting the development of emerging economies. The first of these is the World Bank, which was established following World War II to help finance the reconstruction of economies damaged by the war. Currently, the World Bank provides financing to developing countries with the goal of eradicating poverty. The World Bank is in fact made up of two institutions. The first of these is the International Bank for Reconstruction and Development, and its primary function is the granting of long-term loans to underdeveloped countries to finance capital projects. That is, projects aimed at improving infrastructure. It should be noted that the loans are granted at commercial rates. The second constituent of the World Bank is the International Development Association, which provides loans to the world's poorest economies, aimed primarily at financing human development projects, such as education, child vaccination, as well as construction of basic infrastructure such as paved roads or bridges. Contrary to loans granted by the International Bank for Reconstruction and Development, the financing provided by the International Development Association is subject to special conditions, such as prolonged repayment terms and deferred interest payments. Another intergovernmental organization which provides financing to troubled economies is the International Monetary Fund, referred to as the IMF. The primary goal of financing granted by the IMF is to provide liquidity to countries experiencing deficits in their balance of payments, in the transition period to recovery and the application of corrective measures. Accordingly, contrary to the World Bank, the IMF provides its help not only to underdeveloped economies, but to those which are not in the position to service their foreign obligations. The disbursement of IMF financing is conditional on the beneficiary's government adopting a reform action plan. Once again, the financing is granted on market conditions. Supranational institutions like the World Bank and the IMF obviously increase the stability of the global financial system. At the individual country level, financial stability is provided by central banks, who are among others in charge of issuing the local currency and regulating the level of interest rates. Taking into account that a vast majority of international trade is settled using the world's four major currencies, that is the US dollar, the euro, Japanese yen and Great Britain pound, clearly the policy and decisions of the central banks in charge of issuing these currencies have a significant impact on international trade. A central bank, also called a reserve bank, is responsible for issuing and managing the currency and money supply of a country or currency zone. In other words, central banks are the implementers of monetary policy. The Central Bank of the United States is called the Federal Reserve System, a name which is often abbreviated to the Fed. One of the primary roles of the Fed is naturally issuing the United States dollar, which is the most frequently used currency in global trade. You may find it interesting to know that the US dollar is officially used as the currency in 12 countries other than the United States, and unofficially in over 30 countries. Thus, decisions taken by the Federal Reserve regarding the supply of the dollar and the level of interest rates in the US dollar have a direct impact on the economic reality of citizens of all of these economies. As you will learn later on in this course, in accordance with the theory of interest rate parity, the level of interest rates is correlated with the demand for currencies and thus has a significant impact on exchange rates. So, taking into account that the US dollar is the currency most often used in global trade, the decisions of the Fed have an enormous effect on the prices of goods and services worldwide. The second most traded currency in the world is the euro, issued by the European Central Bank or the ECB with headquarters in Frankfurt, Germany. The euro is the currency used in the monetary union comprising 19 member states, all of whom belong to the European Union. The ECB is a supranational organization with equity owned by central banks of all 28 countries of the European Union. The primary objective of the ECB is maintaining the stability of prices in the Eurozone. This goal is achieved by means of regulating the supply of currency and using tools such as repurchase agreements called repo transactions, through which the amount of currency in the economy can be reduced or increased. The euro is not only the currency used to settle transactions in the Eurozone and the European Union. 11 local currencies of countries located not only in Europe are pegged to the euro, which means that their monetary authorities de facto follow the monetary policy of the ECB. The Japanese yen is the third most important currency used for invoicing in global trade and is issued by the Bank of Japan with headquarters in Tokyo. The fourth most important currency traded globally is the Great Britain pound, called the pound sterling. It is issued by the Bank of England, which was established in 1694 and is the second oldest central bank in the world, with the first place belonging to the Swedish National Bank. As you can see, the international economic environment in which multinational companies conduct their business is complex, and includes on one hand multiple free trade agreements and areas adopting protectionist approaches to international trade. On the other hand, there are supranational organizations such as the WTO struggling to eliminate major barriers to trade. Finally, there are also central banks issuing currencies used to settle international transactions. This complexity of the international economic landscape gives rise to numerous risks faced by multinationals in their international operations. We will be examining these risks in further modules of the course. Meanwhile, in the next video, we will be talking about global financial markets, which allow for the financing of international trade operations.